Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Rocio Wu, Principal at AAM Capital, and Adam Reilly, National Managing Partner of Mergers, Acquisitions, and Restructuring Services at Deloitte Consulting LLP. They join us to discuss the M&A deal activity environment and if we're seeing an improvement in that activity. It is great to have you both with us. Welcome to Trade Talks. And Rocio, we'll start with you. Give us a brief overview of where AAM Capital sits within the M&A ecosystem.
Thanks, Jill. It's great to be back. So AAM Capital is an early-stage global venture firm, and we've been investing in fintech and enterprise software for the last 50 years, and have the privilege to partner with founders like Alibaba and Atari back in the days, and more recently with Plaid and Flywire, which is a Nasdaq-listed company. And in terms of M&A, we've both watched portfolio being acquired as well as acquiring other companies from up close, and also we've tracked the broader M&A trends holistically in our State of Fintech report as well as the Fintech Index.
All right, thank you, Rocio. And Adam, tell us about the work at Deloitte.
Yeah, thanks, Jill, and thanks for having me here. So at Deloitte, we provide end-to-end M&A services across all industries for our clients. So advising from the very early stages of strategy development through transaction execution, through integration, divestiture type work. And also in my practice is our restructuring, which is really cost transformation as well as sort of true distressed restructuring practices. So we help our clients through all of those types of issues and help them maximize the value they're getting from their different types of transactions. It's great to be here today.
All right, and it's great to have the both of you with us. Rocio, let's talk about the current M&A environment. Is the activity similar to what we saw in 2019, or is there still some catch-up to do here?
For sure. I remember last year when I was on the show, we talked about how 2022 was the year of correction, following the 2021 peak of the market. And looking back, 2023 turned out to be the year of stabilization, especially in the public markets. However, the M&A market remains to be actually much lower volume compared to 2021. So as an example, in fintech, in 2021, we observed about $315 billion M&A activities driven by strategics and PE buyers. However, last year, we only observed a $10 billion, $50 billion overall activities. The main headwind there is the persistent lack of agreement between the buyers and the sellers on the clearing price. And we see very similar dynamics play out in the median valuation price as well as the highest deal price. For example, the median acquisition valuation reversed to $330 million last year compared to $500 million in the previous years. And also 1 out of every 5 acquisitions was actually sold at a loss, meaning that companies were sold at a valuation that was lower than the last private round, VC round. And in terms of the highest deal price, in 2021, we saw the highest deal being, the $29 billion acquisition from Square acquiring Afterpay. And last year, the highest deal valuation was only $10 billion from Nasdaq, actually, acquiring Adenza.
Yeah. Adam, what are some of the headwinds that you're seeing in the M&A space?
Yeah, I think across a few different areas. So obviously, I think that the market clearing price, as Rocio mentioned, is really important. And when we think about what's driving that, in our view, there's a few things probably. Interest rates obviously have stayed high, and the expectation now is that they'll stay higher for longer, probably than people were thinking earlier in the year. And we obviously had some inflation data come out today that sort of supports that higher for longer. So that's a challenge, makes financing more expensive. There's also geopolitical risks around the world that are much more challenging than they were a couple of years ago. And so we're monitoring that. That definitely is a challenge, particularly for those larger global deals. Regulatory environment. We've seen some actions by antitrust regulators around the world that have made companies a little more hesitant to know where those are going to shake out in their deals. And so those are challenges that we're definitely monitoring across everything. I would say, if I flip into some of the tailwinds as well, I mean, I think there are a lot of good things to point to as well. I think, a lot of those risks that we have seen are out there and are starting to get priced in and are starting to be digested by the market. We are seeing a bit of a return to increase in value, larger deals getting done. I think that's always, to me, an indication of people willing to take bigger risks. Volume certainly hasn't returned yet, but the value indicators could be foretelling maybe the return to more volume of deals.
Yeah, to add on to the tailwinds, definitely, first of all, I think M&A remains to be the highest probability path for a large exit. Historically, at a ratio of 10-1, M&A represent a very highly frequent and a large path to liquidity compared to IPO. And the second, the buyer universe is actually very diverse. So many people only think about big tech as the buyer, but actually, large financial institutions, banks, even newly minted startup, they are becoming more acquisitive. And then lastly, with the IPO market started to soar, we see Rubrik IPO yesterday, along with 3 other tech IPO earlier this year. Definitely, it will give another momentum to the M&A activity to rebound.
Yeah, and that's a point that you make, Rocio. In the IPO market, we're starting to see sectors broaden out as well. It's not just specific to healthcare or specific to tech, to your point. But you had mentioned that the valuations have declined from 2019 to 2023. Certainly, was that valuation reset necessary? It seems as if this growth at all costs and just kind of throwing money at any idea in the tech space, fintech space, without thinking about the balance sheet and recurring revenue streams and governance and so forth. It seems as if operational efficiency is more important than just having a good idea at this point.
For sure. I think the capital markets, they are rewarding companies with high capital efficient growth. So it's not only about growth at all costs. They take gross margin into consideration, especially in the private markets. The burn ratio, how company effectively acquire revenue with how much cost, is definitely on top of people's mind. And also, just to double click on fintech, it's not one size that fits all. So we have seen, for example, B2B vertical SaaS company with a payments revenue stream. They are rewarded with much higher multiples, like maybe 6 to 8x multiples compared to prop tech or insure tech or banking, which has more transactional revenue and less repeatable and less predictability. So they are rewarded with only maybe 2 to 3x multiples. So definitely there is a wide range out there.
Yeah. And Adam, in the 2024 M&A Trend Survey by Deloitte, I thought it was interesting that it's not companies only acquiring other companies, but they're also, internally investing more time and energy on their internal transformations in the past year. Can you give us some color behind that?
Yeah, absolutely. I think it's a great point. I think as we saw, the M&A markets cool, a lot of focus did return to internal restructuring and ensuring that you had the cost profile of your company right, and so working on that. And so we'd seen in our survey 68% of companies said that they had embarked on some sort of cost transformation or restructuring project since the beginning of the pandemic. We think there's still more of that to be done, but a lot of that hard work has been done. And so we're starting to see those deal makers pivot again back out into thinking, where is that growth going to come from? Because they've sort of squeezed what they can out of the balance sheet and the P&L that they have already. And so we saw 83% of our surveyed, which is 1,500 corporate and private equity executives, 83% saying that this year they'd expect more deal volume to return. So we're starting to see Q1 was a better quarter, and so we're starting to see that actually play out, I think, in the markets.
Yeah, I think the deal makers are definitely preparing on both sides, on the seller side and also on the buyer side. So on the seller side, we are seeing that companies start to invest in building relationships with potential acquirers much early on. One thing that's worth noting is a decade ago, about 50% of the acquisition happened in early stage, meaning that companies that were acquired, they just raised seed and Series A. However, today, 3/4 of the company were acquired at early stage. So companies are definitely investing in building relationships early on. And the second is valuation discipline. So as I mentioned earlier, the mean M&A price has reversed to only $330 million. So as companies start to grow into the growth stage, entering the 300 to 400 million territory, they start to be more cautious about what is the buyer universe out there, because it has significantly narrowed down. And on the buyer side, we have seen buyers to be more opportunistic and more strategic. So for example, on the strategic side, you have seen Capital One acquiring Discovery, to be vertically integrated. And also you have seen buyers such as TabaPay that is becoming, as the banking as a service market consolidate, they want to acquire assets of other players. And also companies are monitoring what are the acquirers that's available in the market to acquire both IP and the talent team at a much attractive price.
Right. And Adam, how are C-suite leaders preparing their organizations for deal making?
I think, the deal-making environment is obviously it's complex. And I think what people are really focused on a little bit is getting back to basics. And so when we found in our survey a tremendous focus on getting the right strategy and then really doing the work in diligence to actually understand the business. I think in this kind of an environment, I think people realize that the market is not going to save you. You're going to have to do the right deals and really understand the risks and the opportunities from those deals. And so people are really focused on that early stage preparation as being a real driver in their transactions. Again, because I think they realize that it has to be the right deal and it has to be done the right way.
Right. But how is tech playing a role in M&A, Rocio?
Yeah, it's really interesting trend. We have seen AI, either predictive AI or generative AI, start to play more meaningful role in the life cycle of deal making. So you have the deal sourcing to deal diligence and the relationship mapping. So on the sourcing side, companies start to collect signals from the public data and also try to identify potential buyers and a suitable target. And in the diligence side, with generative AI, it can really process large amount of data sets very quickly and efficiently, try to identify the risk areas and also summarize the financial health and the competitive landscape of the target to produce actionable items for the deal team. And on the relationship mapping side, we have seen they start to construct the email graph as well as mapping external and internal relationships so they can identify who is a warm intro to the target, or they can seek some reference check on the back channel. And one company we've been talking to, actually, they are working with Deloitte on a potential pilot on this project. So it's really happening.
Yeah, Adam, I thought it was interesting. The survey also noted that almost all the respondents, 99%, indicated their respective corporate and private equity organizations are incorporating some form of Gen AI.
Yeah, Gen AI or advanced data analytics, which we kind of put a little bit together because they're both kind of looking at big data sets. How do you get to better answers faster, right? And if you think about that, that as a Gen AI being a tool to really help you do that, analyze large quantities of data, come up with more insights faster, there's really no place that you would rather deploy that than M&A, because that's what the whole goal of doing the work is. So we are seeing a lot of people spending a lot of time. I think we're still early days. I think this is going to be an emerging trend we're going to be talking about for many years to come. But we are starting to see the use cases begin to play out and people actually deploying these technologies in pretty useful ways.
Yeah. So, Adam, at the end of the day here, it sounds as if both you and Rocio have a positive outlook for a renewed M&A deal environment, particularly with divestitures.
I think that's right. I mean, I think if you look at, another tailwind that we have in the market on the private equity side, there's a tremendous amount of capital ready to be deployed. There's also a lot of portfolio companies held by private equity who, will eventually need to get sold, and that, the timelines, that the hold periods don't last forever, and so they will need to start moving those deals. So I think those also provide us some opportunities to see renewed activity. I think we are seeing some, corporates coming out of some of the work that they did on their internal P&L and balance sheets, realizing there's some non-core assets and looking to divest those, and so those will present opportunities for buyers to take these carved out assets and set them up in different ways, either incorporating them in their own organization or standing up as a new business.
Right. I think Q1 data speak for itself. So fintech alone, they already reached $75 billion in the Q1 alone, surpassing previous quarters since 2021. And also we continue to see, as Adam mentioned, the private equity shops, they have a large amount of dry powder sitting on the balance sheet. So they're definitely positioned to acquire those attractive assets, but at a probably distressed price.
All right. Appreciate both of your insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.
Thank you.